everyone for joining us. It's going to be a fun morning here. A couple things that I'm passionate about to talk about, and one of them is a bit of our economic position, and then some go forward strategies. And I'm going to talk about a list of things that I'm excited about and a list of things that bother me, and hopefully give you some nice things to think about over the next few months and remainder of the year, really, and really plan to make 2024 extremely successful and set yourself in a great spot going forward into 2025. So with that, again, thanks, Mindia, for the introduction. Charlie McQueen, President of McQueen Financial Advisors. I'm super wonderful group I get to work with, which makes my life really easy. I've got our investment advisory division headed by Craig Cecilia, who actually manage bond portfolios for credit unions. We also do EBPA and CDA accounts, otherwise known as alternative accounts, manage money for foundations, unions, and we actually have an individual investment management, high net worth individual investment management arm we just started this last year, or partnered to start this last year. So super excited about that. Along with that, we also then our second area of services, our asset liability management group. We do interest rate risk reporting, all of the accoutrements, all the accompanying reports, and also CECL, which has been a very interesting thing, because we're going to talk a little bit here about bumping up of credit problems and losses. And then our third group is our valuations team. We value all sorts of things: mortgage servicing rights, mortgage companies, QSOs. We value credit unions and peer-to-peer credit union merger. And we also do a lot of work in acquisition of banks. We started the trend of acquiring banks. We've now done about 60% of them. We've acquired about 32 banks now for our clients. So super exciting area. But which makes my life fun and easy, because I work with all these great people. And so when talking with all these great people, they ask one question on a very regular basis, besides our internal group, but also our coworkers. What is the Federal Open Market Committee going to do? So the Federal Open Market Committee controls the Fed funds rate, and that is what the world is wondering what's going to happen here. A lot of conversation the Fed was going to lower rates this year. Now we're having some conversation the Fed may raise rates this year. It's a bit all over the board. And so to really understand what the Fed is going to do, we just have to ask two important questions. But before you have on those two important questions, if you have any questions along the way, you will see the Q&A box. Click it there and ask away. Happy to answer questions on the fly. You can also answer them at the end. Look forward to having a great interactive conversation. So don't hesitate for clicking on the Q&A button, and Bindia or I will call on you or talk about it and answer it. So thank you. But now that we're done with the housekeeping, what's the Fed worried about in a housekeeping standpoint? Well, there's two things. And the Fed has a dual mandate. It's price stability, otherwise known as inflation under control, and full employment. And so let's experiment and look into those two areas. And what I will tell you is when we're at a level of full employment and price stability, the Fed will actually lower interest rates a little bit because they don't want to break it. But if inflation is too high, they're going to keep interest rates high. And so the Fed has to look at those two things. And in some way, you cause unemployment to go up to slow an economy, which would then keep inflation in check. So a couple different ways of looking at this. So kicking off number one, inflation. All right. This is a neat graph here. It goes back from 2005 all the way to today. We have three different lines here. We have the black dotted line, which is everything, the consumer price index. It's the most volatile because it includes energy and it includes food and all sorts of different things. Then we have the consumer price index X food and energy in blue, which is a bit more stable. But, last I remember, the food and energy do bother me as I buy those every day. And last but not least is the red dotted line, which is the Personal Consumption Expenditure Core Index, PCE, otherwise known as, and that's the favorite of the Fed. That's one they pay a lot of attention to. So if we look at these lines throughout the years, they've all been effectively 2%. Now, take the dotted line out, the overall consumer price index. We're not far off 2%. We go down a little bit. We get to 1 as a low. We got to 3 as a high. And then, 2021 came about. And we saw inflation take off. So looking at this a little bit of a closer graph, inflation has taken off and is much, much higher here. Now, what this means since 2020 and actually going back farther, we haven't had disinflation. We had really high inflation. If we look here in 2020, we were running about 4% a year. 2021, 5% a year, another 5 or 6% a year in 2022. And it compounds. That's 6, 12, 15, 16% inflation. And then now we're coming in again around around 19% inflation here in the last couple of years plus, because it's a compounding number. So where we are today is that prices are rising still. They're just rising at a slower pace than they've been rising the last couple of years. So we still are in an inflationary environment. We haven't seen anything disinflation. We're not seeing inflation go negative. We're just seeing less of a rate of inflation right now. Now, one of the things that's really kind of crazy to me here is looking at the breakdown of the subcomponents of inflation. This chart here, we go through a few things. We have all items, food, energy, all items, less food and energy. Well, when you graph all this, you'll see 3 of these lines stick together and one is actually down from its peak, but still up since 2021. Because we have years here, 2021, 2022, 2023, and that's energy. What we've seen here is that energy prices have been the best thing for us, limiting inflation. If energy prices were higher, we'd have higher inflation. One of the things that's really important to remember, the United States of America became the largest oil producer about 8 years ago in the world. We lost it, and then now we've gained it back. So it's really, really incredible that we are the world's largest oil producer. I love it. We produce oil much cleaner than other countries, and we're also giving wealth to ourselves versus giving it to other people. So something really important here, this low cost of energy, oil and gas has really helped us through a difficult period. Again, if it was much higher, we'd have a lot of problems. Now, one of the other pieces of debt right now, or inflation, is debt right now. This is something that's getting more and more notification. You'll read about it more and more. But our elected officials, or if we call them that, we had to have fun. We can go on some conspiracy theories here, but the people in Washington clearly have zero economic sense and have no way of understanding what this world means. We are seeing debt skyrocket. It's just truly unbelievable and scary here what this will leave our kids with. If we look in 2009, right here, financial crisis, let's look at here, we were roughly $9 trillion of debt. And fast forward to today, 2023, 34 trillion in debt. So we've actually gone up 4 times in the last 14 years. We've 4x the debt. We're doubling the debt every 3 to 4 years. It's absolutely unsustainable. We're not going to be able to, especially these current interest rates, be able to afford the interest payments. People are talking about Biden coming out with talking about nearly a 50% capital gain tax rate that he's proposing. All sorts of things that are really, really bad for economic activity. So I think it's something imperative we get some people in Washington to understand, but this is part of the inflation problem because the government is printing money and spending it, causing demand to be higher and causing inflation. Anytime anyone says we have an inflation bill that's going to reduce inflation that involves spending, that's not a true inflation reduction. This is something that gets me and concerns me, something I hope we pay a lot more attention to. But where we are today, with the debt increasing, with the rate of inflation that we have, going back a slide here, the Fed is most likely not going to be lowering interest rates until a couple of these issues get paid attention to. Now, the other side of the equation is employment. And it's really important because, again, that dual mandate, price stability and full employment, we're looking pretty good right now. If you look at this national unemployment rate, we're down here at record low levels, 3.8%. Illinois running at 4.8%. And unemployment number of weeks is really low. I mean, we are at what I would say is full employment. Anything above 5% unemployment, we consider full employment. So with that, what else is going on? Well, we have the labor force participation rate. Really interesting graph. We are right back right now, participation-wise, where we were in the 80s when we had the last spike of inflation. We were around 62.3% of the population active in the labor force. All the baby boomers, we actually had a whole bunch of dual incomes, a lot of people working. There was a ton of people. We were going to talk demographics in a couple slides. A ton of people that came into the marketplace, and they worked, and we got all the way up to 67%. Well, Gen X is a smaller group of people, but Gen X is also more apt to have one person at home after growing up with 2 income baby boomer households. But we also saw here with recession in 2008-9, a drop in the participation rate, a huge drop, almost a 1 point drop from 66 to 65. And then we continue to decline down to 63%, where we stayed till the pandemic, and we're back. So definitely a lot of interesting things. And along with this, we've been seeing these very interesting employment reports, just consistent data, the same. But when you dig into the data, it becomes a little bit more interesting. We're seeing a swing of full-time versus part-time jobs. Now, how this is defined here, purple is 35 hours or more full-time, and the green is less than 35 hours or part-time. And the graphs add up to 100%. So for 80% in full-time, we're going to be 20% in part-time, as it's the total workforce. So what we're seeing here is that in times of recessions, we see the full-time employment come down, and especially in 2008-9, major downturn recession that we had. Full-time employment comes down and part-time employment comes up, which makes a lot of sense. You're running a company, you're worried about fixed costs, you're going to get rid of full-time employees, apt to let them retire or fire, and then hire back on part-time employees. And then eventually, as you feel more and more comfortable with the positions, you start filling them with full-time. And so we went through this natural trend of full-time jobs dropping down, part-time jobs going up, and then part-time jobs going down and full-time jobs up. Now we got to take a jump and take a little cut out of here and just remove the pandemic. But what we've seen happening now for about the past 5-6 quarters is a fairly significant reduction in full-time employment and a growth in part-time employment. And so we're seeing part-time employment grow here. Is this a foreshadower of a possible recession? I don't know that. But it is something that the Fed is starting to pay attention to. And or is this a desire that people want to work part-time jobs? Do people prefer that right now, the job type market? But what we're seeing here is that we definitely have some good data from an employment standpoint. We're worried a little bit about the switch from part-time or from full-time to part-time jobs right now. But overall, the employment side of the equation is really good. The inflation side is still high. So with that, we do see that the Federal Open Market Committee is going to remain on hold until we see more data. That's something hopefully we'll see a bit more data here soon. A lot of people talk about an election cycle, and the election cycle doesn't bother me much. The Fed changes rates in election cycles. They prefer not to, but if they have to, they do, and they've done that forever. But with that, what are some other data points we can use to help us understand what's going on and look at some interest rates? So with that, the value of what we make has been going really well. Gross domestic product, the things that we make. If we look back going to 2007, there was our blip with the Great Recession, to give us an idea when things really fell apart, the housing crisis. But we've been somewhere in 0 to 5%, let's call it an average of 2.5% gross domestic product. And then we got to take the heartbeat out here, which was COVID. But if you look since COVID, these have been really big swings and consistently higher numbers than we've expected. A lot of this has to go with the amount of government debt. As the government keeps spending and putting money out there, that spending causes more things to be bought, which is causing the economy to be bigger than it should as we're doing debt-based spending. So it is good to see. We do expect, and it's hard to have a recession when you have really good economic activity. And one of the things Jamie Dimon was quoted last night at the New York Economic Club, talking about that the consumers are resilient, the economy is going well, and this is one of those data points that shows that. So thinking about another data point that's really interesting to me, we're looking at the yield curve. The yield curve. We start here at 3 months and go all the way out to 10 years. The red line is the current yield curve. It's inverted. Black line's a normal looking yield curve. This is back from 2012. But really interesting to see here in March of 24, just a couple days ago, we're definitely inverted from high fives at the short end and mid fours at the low end. But we've been in the longest inversion now, or actually we're longer than the longest inversion. The longest previous inversion in 1978 was 624 days. And what we mean by that is the 2-year Treasury yields more than the 10-year Treasury. We're now at 628 days as of today. So we're back to the 80s again. We're back to the 80s, inflation, and what happened there. And so the inversion we see is probably going to continue and continue to set records. Well, why have we seen this inversion happen for so long? Well, if you look back in 2005, and this is one of my favorite charts, and it goes all the way from 2005 to today, the red line is the Fed funds rate, the black dotted line is the 10-year Treasury, and the blue line is the 2-year Treasury. So you can actually physically see the inversion for a period of time. But here, as the Fed was raising rates, we see that here the 10-year Treasury just started to invert right when the Fed basically got to the top. And then as soon as they started bringing down rates, we de-inverted. Well, if we look at the current situation we are in today, we actually inverted right before the Fed raised rates. So many people were predicting the Fed to raise rates, the market inverted before the Fed moved. And we've stayed inverted since mid-2021. And we continue to be inverted today, as we can see the 10-year Treasury right here. What is that telling us? Well, that's telling us that the market believes that the Fed will get inflation under control and eventually have to bring rates down. So therefore, we don't have to have long-term rates as high as we need them. But short-term rates, because it's a short-term phenomenon, need to be higher, but long-term rates don't need to be that much higher. So it's a really, really interesting spot and a way of looking at stuff. All right, from here, Fed funds rate is the really important thing we want to pay close attention to. And that's the question that everyone's been asking me. So if we look at the Fed funds rate, what's happened here? Well, Fed funds rate has been skyrocketing. And the reason why it skyrocketed was because of all the things happening and all of the inflation. So there's our kick up. Now back here in 17, 18, 19, the Fed was raising rates because the economy was doing better. It was doing well. But then we had our pandemic and we dropped all the way down. So in reality, we came too far down for the pandemic based off the amount of stimulus. And we'll talk about that in liabilities and deposit pricing. But definitely something we need to think carefully about as we go forward. So what is going to happen? Is this rate going to go up from 550? We're going to go to 575.6, or we're going to start coming down? So to get that answer, we look at a couple different things. And number one is we're looking at the Fed funds futures. This is the betting in the bond market, not the Fed predicted, not anything, but just the betting in the market. So obviously we're past the March meeting at 550. May, it's supposed to be 550. June, we're talking about between 550 and 525. It's starting to get a little dicey there. Some reports are even pushing that out to July, September. But this is even just a little bit more of an aggressive cut when the day this picture was taken. But this put us all the way down to 475 by December of this year. A couple months ago, people were calling for rates to be down as low as 3% by the end of this year. Definitely a lot of volatility in here, and I really go back to the data dependency. We really need to make sure we keep a close eye on the inflation numbers, because those inflation numbers are going to be the ones that are going to set what the Fed is going to do. The Federal Reserve, the last thing they want to do is have a repeat of what happened in the 80s, was they started to lower rates too soon and inflation came ripping back up. So they had to raise rates back up and cool it down. So they don't want to have that same mistake that they made last time. So with that, another way that we look at rates is the Fed dot plot. And here's where the Federal Reserve decided in their brilliance years ago that they were going to give individual participants on the Federal Reserve Board to pick and put where they think rates are going to be, and then they put the dots all in one spot. So what this is showing is 2024. A couple people think it's going to stay at 550 for all of 2024. Some people think 5.25. A bunch of people think 5. A bunch of other people think like 450, 475. And we've got one person that really thinks, wow, we got to drop it down to an outlier. What really becomes interesting to me is when they predict 2025, the disparity of the Fed board governor members, who we'd think would maybe have a little more of a understanding, we're as low as 250 and as high as 550. That's 3% difference in the board. They're really scattered from 3 to 4.5%. That's 150 basis points. I'm assuming it's the same person here. Their dot is way out here in 2026, where they're still at 5% in 2026. Now, the mean and the average you can see here has it coming down to around 4% in 2025. And then 2026, 350, 325, somewhere in there, 325. And then long term down to 250. So a lot of different numbers coming from the Fed. The trend shows that the Fed believes that rates are coming down. My viewpoint is that rates are going to probably come down in time, but we definitely need to see that inflation number get under control. And along with that, we definitely need to get our national debt under control, as we can't continue to spend at the rates that we are. And if we do, we're going to have to raise taxes to such a degree that it's going to kill the economy. So one of the two will kill the economy. Either it'll happen naturally or the Fed or by government and tax levels. Not the rosiest pictures thinking forward. Hopefully none of that happens and we get a slowdown in the economy. We get some people elected to this country that can understand debt and we move forward. So speaking of moving forward, housing. Housing is one of the most questioned things I get on a daily basis. And it's pretty amazing what's happening in the housing market today. And if we look at this, a lot of things are going on. And so I wanted to give some background data. People say all the time there's not enough new homes being built. That's partially true. I don't think that's as big of an issue as people say, but if we look back in 2010, there are 309 million people in the country. Today, 333 million. We grew by 24 million people. The number of houses estimated 132 million, went to 146 million, a 14 million increase. So we grew 24 million and we increased 14 million of homes. It was 2.35 people per house in 2010. Now we're at 2.28 people per house in 2023. Not much of a difference there, pretty flat. So we have been growing roughly at the same level. But here are some of the more difficult things. The marriage rate, 35% of 1,000 eligible adults would get married on average in 2010. In 2023, it's now down to 30%, or 5% reduction going from 35 to 30. Divorce rate is still the percentage of people getting divorced, 18.7, now down to 13.6, so it's a 5% reduction also. So the divorce rate remains near record lows. It came down substantially because of the pandemic, I should say, but the marriage rate has still continued to stay very low. Well, what does this mean? Well, this means that if people aren't getting married and both two people want to buy a house versus getting married and buying a house, we do need more homes. So keeping this old percentage of people per house is not going to last well, and it's going to cause problems unless we see marriage rates go up or people convert to staying in apartments much longer. So from that sense, we do have a bit of a shortage because of the declining marriage rate. At the same point, there's a huge issue with immigration, legal, illegal, however you want to call it. The illegal immigration component is not included in the numbers. And so as people come across the border and they want to move into houses or rent houses, it becomes a bigger issue. One of the things we also can't track very well yet, we're trying to, is the number of homes in VBROs, vacation rentals by owner, that takes housing stock out and turns it into rental property. In the end today, 40% of Americans don't feel like they can achieve the homeownership dream. And that is a number that's going to be very, very difficult and cause problems for many years. We want to see that reverse and see people happy with and get the homeownership dream. Well, if you think about this, the homeownership dream is tough, but one of the interesting issues here is there's a lot of people that don't want to move and can't move. So this chart here shows two things. The blue line is used sales, existing homes, used sales. It's off the right-hand chart. We're currently at a 4 million pace, new used sales every year. If we look back, we're lower than where we were in 2009 post the great apocalypse home reduction. So less homes are selling than there were in 2009 after the world fell apart. The red line is new home sales. Now, what we don't see here is if we go back to 2004 or 5, new home sales were closer to 2 million. We never got anywhere back close to that. We did go all the way up to almost 1 million here in 2020, but given costs and structure, we're still at a low level of about 600,000. So there is a lack of new home inventory out there, and it's working. A lot of people building, and maybe not always in the right spot where people want to be or people need houses, but people are building. But what this is showing is a supply and demand problem. And if we look at this in a little bit more granular here are the single family homes for sale at the end of each period. So October 2023, there was 1 million homes, this is in millions here, thousands, 1,010,000 homes for sale. If we go back to 2008, there were 3.5 million homes for sale. The average, if we take out the bumps and the different things, the number of people with two homes in 2008, 9, and 10, and we go to a normal level, it's somewhere in the 2 million neighborhood. So we have 50% less homes out there. And so we have a significant number of people looking to today that can't find them. And so the supply and demand issue here, what it's doing is pushing home values up. This is a chart of house price index, and it is going way up. And the next page is actually an interesting one because we're tying in the home price index, the S&P Case-Shiller National Home Price Index. And guys, just remember this. This is 2006 here. This is the top of the housing bubble, 2006-7. Values were here. We came down. Now, time went by. People were buying homes. We kind of got back on this trajectory. And then the green box here was the accelerant. This was the gasoline poured on the housing market. If you look down here, the blue line is the 30-year fixed rate mortgage rates, 30-year mortgage rates, fixed rate. The Fed was actively buying treasuries. They were doing quantitative easing, buying huge quantities of treasury bonds and mortgage-backed securities, and they drove the 10-year treasury down to effectively 1%, and we had mortgage rates between 2.5% and 3% for a period of time. So what ended up happening here is this explosion of value. Right here, you're going to see we went from 15 to 20 on my index. And if you look at the index, we're now at 22. But from the expanse of time, we went from 0 to 15. And we went 15 to 20, which is just incredible. 25% of the index growth happened in about a 2-year time frame. One would expect, though, with treasury rates high again and mortgage rates high again, 30-year fixed rate mortgage rates at 7.5%, one would expect that we'd actually see at this point, we would actually expect to see values decline. But they're not declining. And the reason being here is there's a lot of people with 3% mortgages that cannot move. They can't afford to move in this new environment. So if we look at this, low cost, low mortgage rates, low sales, inability to move. And so people can't move. They can't afford the new spot. High mortgages and high taxes are making high cost of ownership. But inflation's always also causing some big problems. If we look at what's happened here, insurance has gone insane because the cost of replacing stuff, we're talking 200-300% increases in insurance in some markets. Even here where I am in Michigan, a 30-40% rate of homeowner and car insurance is normal. And so that compiled with property taxes, extremely high property taxes, especially with these higher valuations, we're seeing forced sales start to take place. A lot of forced sales in the west coast of Florida and in California right now. And so we're starting to see some turnover, but it's starting to cause some price reductions in some markets, but just not every market yet. So thinking about the fact that we're making these loans on houses and it's changing, a lot of things are changing with loans. And I think the first thing to take from that is, well, wait a minute, when I'm lending money to someone, how is all this affecting them? Well, the biggest thing is payments. Right now, first-time home buyers, and this is even worse for existing home buyers, first-time home buyers had a $1,000 a month payment just recently in 2019. That was the average. And if you look back over this chart, it hasn't been far except in 500 to about 1,200. And in a matter of 2 years, we've gone up to 2,200. It's 2,149 here. A new chart came out this morning. It was about 2,400. So we've seen the average principal and interest payment more than double, almost up 2.5 times in just a matter of 2 years. And so this is making it very difficult for individuals to buy homes. And this is also making it difficult as we think about when lending money to someone, how much of their money is going to their home loan versus other activities. So for here, really interesting to me, there's some product changes. People aren't going to go out and just get 30-year mortgages today. The homes have become too expensive. There'll be some volume there. But again, we have a lot of people stuck in their homes effectively. And so what's going to happen? Well, we're going to see a bunch of people getting second mortgages to add a bathroom, home equity line of credits to update a kitchen. I do think, though, that some people that are buying today are really going to be focused on floating rate mortgages versus fixed rate mortgages, as it might be concerned that it's not the right thing to do, that fixed rate mortgage, given the rates where we are over a long period of time. So with that, a couple things to think about in lending. we are seeing a massive change in loan market participants. What I mean by that is mortgage companies are bored. And so mortgage loan officers are trying to be creative as they can to look at ways to encourage people to move, looking at ways to try to refinance, do debt consolidation, look into other areas. And so we're going to see more and more competition from mortgage company people. Fintech. Fintech, I always love the name. We have to talk about what does fintech mean. A lot of times fintech is aggregators of loans and making a spread when aggregating loans. Well, fintechs are growing very quickly right now, and they're pushing because one of the things, it's hard to get debt financing or hard to get equity financing in the fintech space today. So a lot of them are pushing really hard for profitability. And so with all that happening, we're getting more and more competition. So speaking of competition, here's a great example. Saw this on TV the other day. Chrysler Pacifica marked down from 51 to 48,000. Good looking minivan there. Come on, black wheels, looks nice. Stay nice and cool in the winter and the summer with the white paint. They're advertising a 2.99% rate for 72 months. So there's no way we can compete with people when they're doing a 2.99% rate for 72 months. It just is impossible for us. So we want to make sure we're not competing with things that we cannot compete with. So loan pricing is something that I want to make sure everyone thinks very, very carefully about. This is an old pricing build-up example I made, and I always like to share it. It just makes you think when you're pricing loans, competing directly with that 2.99% is a really bad idea. So how do we do a loan pricing buildup? Well, what is my incremental cost of borrowing? If I'm going to bring in a deposit today, what is that deposit rate going to be at? Here, 5.25 is my example. It could be 4.5 for you. It could be a different number. Modify the number. What's my servicing cost for the loan? Obviously depends on the type of loan I'm doing. I put 50 basis points here. What's my CECL cost for the loan? My loan loss reserve. Depending on your product and what we're doing, it's going to be anywhere from 0 to 7,500 basis points. I want a 1% ROA. That's what I believe is correct. If I throw that in there. So I add all that up, that gets me to a 750 market rate, what I'll call the neutral rate. So if I want to be really competitive in the market, 750 is somewhere around there is my number. If I don't want to be as competitive or I'm worried about a little bit things in the market, maybe I go up another 100 basis points to 8.5 to keep my growth in check. We have this model on the MFA Navigator, our website. Love it. Something fun to play with. But another way to think about this too is if my incremental cost of funds is 5.25, if I add 3% to that, that's 8.25. That's a 3% margin. If I want to think about from a margin standpoint, that's where my average yield on assets needs to be. My incremental dollar coming the door is 4%. That would mean 7 for a 3% margin, 8 for a 4% margin. Very interesting way to think about it, but we need to make sure we're thinking through all this very carefully. But with that, we are seeing delinquency pop up. One of my favorite charts here, it's long-term delinquency, credit cards, auto loans, home equity. What we're seeing is auto loans and credit cards start to peak up here. And looking a little bit more direct into this, we'll see that credit card delinquency, we're now up to the highest point we've been since 2010. So we've come all the way back up. Now we're not as high as the 4 to 5%. So I do expect credit card delinquency to continue back up to normal levels. The other thing we're seeing though is subprime auto delinquency, 60 days plus, is actually at an all-time high now, going back a number of years. So we are seeing some significant here, and this chart just goes to 2006, but we are definitely seeing subprime delinquency go up quite a bit. So these are some things to keep an eye on when pricing loans and making sure we're covering the risk structure and making sure we're thinking carefully about that. So with that, funding of loans is such an important thing, and deposits I get asked questions on every day. What's going on in the deposit world? Well, deposits have been declining. We grew forever, and then we had the pandemic, crazy money from the government, and then we've been declining. Now we're starting to see it level out, if not even go up a little bit. But the reason why I expect deposits to continue to decline and be tough to get is money supply continues to decline. M2, if we look at this over a period of time, here's what happened in the pandemic. Our government went insane. We had 5 years worth of money supply growth in about 4 weeks. And then we've been pulling money out. The government's been taking money out. We're doing quantitative tightening. We're not all the way done on a consistent growth pattern, but we definitely have a bit more to go out the door. Now, with that, people are saving money, not as much as they did in the past, but when that pandemic hit, the saving rate skyrocketed. Saving rates back down to more of a normal level, if actually not a little bit below. When going up to recessions, people spend a bit more than they have, and then when recessions hit, their savings go up. So our savings rate is coming down a bit more than I expect. A lot of times I hear people saying it's the cost of everything they're buying today. It appears that that's going to continue. The next component, though, is disposable income. This is another one we want to keep a close eye on. As things cost more and people, if they're struggling with buying things, we'll see it really show up here in the data. And we're beginning to see disposable income come down. We've got to take out this pandemic stuff, but historically disposable income is somewhere around 3, 4, 5%. And we're a bit lower than that right now, which makes us have a little bit of concern. So with that, I love this chart, demographics. What does it all come down to? There's a life cycle of our members. We go from borrowers to savers. And we've always had this group of people that are really incredible, Gen Xers, but they're really small. It's a small group compared to the baby boomers and compared to the millennials. And so we have this big group that's shifting from borrowers to savers, and there's not as many of them. And the baby boomers aren't dying as fast as everyone expected. So the wealth transfer, while it's happening, is not as great. So I do think it's going to be a challenge to get deposits as we go forward for the next couple of years. And we had predicted actually that we'd have 5 to 9% deposit reduction in 2024. I'm a little closer to -2 to 3%. We're seeing things a little bit better, people spending a little less here and there. But that's something that's going to still be difficult. And it's okay to have negative deposit growth for a couple of years, not long term, but for a couple of years. But with that, deposits are expensive. And because deposits are so expensive, I really want to make sure we're thinking about income growth. Income growth is really important to me because to be able to continue to attract expensive deposits, unfortunately, or deposits, we've got to have good earnings to support them. And one of the things that's just really important to remember is that we are in a margin business with fixed costs. We really run a solid net interest margin. And what we need to do is make sure that we're earning good numbers in our margin. If we do good with our margin, we do good long term. So looking at our net interest margin, really interesting to me. And this is broken down by asset classes, and this is bank side data, just the volume is so much higher. But we'll see here is the average in the banking space has come down quite a bit. You know, this is 2.5%. That's not where you want to be on a margin. It came all the way back up to around 3, and we're coming back down a little bit right now. Why is that? Well, loan volume has been fairly flat. Yield has come up, but it takes a while for those loans to reset up. At the same point, deposit volume is down, and so we're having to really go out and market and borrow and do different things in CDs, all while costs are up substantially. So really, really important that we're thinking about managing our margin in good days and bad days. And we're in a spot right now where things are okay. And I'm worried that we, again, don't have enough assets repricing. A lot of people were too long on investments, but not enough assets repricing, which is making our margin get tighter. And so if we think about this, balance sheet management really matters. And we enter into 2024, we need to make as many profitable loans as we can. We want to grow deposits as much as we can. We want to grow solid relationships. We don't have to grow every year, but if we grow every 5 years, a decent growth rate, we're good. We just also don't want to shrink over a 5-year time frame. But don't kill yourself over 1 year with what's happening. And so thinking a little bit about the big picture here as start to wrap stuff up, management of our balance sheet is really important. And the CFPB is putting some crazy numbers of $8 maximum credit card late fees, ODP fees coming down. Good old Biden's junk fees. I don't know where those are coming from, but just to understand what's happening here, 11% of banks lost money in quarter 4 of 23, and 25% of credit unions lost money in quarter 4 of 2023. If we look at this, the average ROA, the top 10 performers went down to almost 50 basis points, and the rest of the world at 46. And this is down from 120 and 92 basis points. So everyone's struggling with the cost of funds going up, and it's starting to cause some issues today. So a couple things to wrap up what I'm thinking about. Things that are bugging me is leadership. We need to have more conversations. We need to listen to multiple sides of a dispute, argument, decision to raise or lower rates. We need to talk through it. We need to be a leader. We need to develop a conversation. And as a leader, we need to make a decision. Doesn't mean everyone agrees. Shouldn't be unanimous, in my opinion, but we make a decision and then we leave the room. We're all in the same spot. We need to focus on leadership. Next thing is liquidity. I'm nervous about liquidity. We're going to continue to see liquidity challenges. We need to constantly, every day, go out and get non-maturity deposits and keep pushing. The other thing today is I'm worried about capital. Capital is lower. It's lower because of OCI, CECL, the growth we've had, and expected credit losses and some credit losses. And we need earnings to supplement that capital. We need to have good margin. We need to have good non-interest income. We really need to focus on that as we go forward. And from there, importance of scale. Something here that I think a lot of people forget, and this is one of the reasons why we help people buy banks. A $50 to $100 million credit union is running at a 76% efficiency ratio, which means you're spending 76 cents to make a dollar. 1 billion to 10 billion, you're spending 65 cents to make a dollar. 11% improvement just because of scale. And in the banking space, this is why we see so many banks declining. This is also why we see so many credit unions declining. We're going to continue to have to work hard to be able to grow efficiently and effectively to keep up with the competition. And as you get bigger and those efficiencies come in, you can have lower loan rates and higher deposit rates, which makes competition really, really difficult. So with that, some key takeaway points. Interest rates, I bet they're probably closer to unchanged for the remainder of this year. It's all going to depend on inflation. If inflation drops like a rock, more conflicts break out, we may see it come down. But if inflation goes up, we may see the Fed raise rates. It's really important that we think about leadership and that we're also diversifying our balance sheet. We're managing liquidity. We're working on long-term deposit growth every day, asking for checking accounts, doing that every day no matter what's happening. Managing that margin, which is really based off those deposit costs, continue to grow net income, and the result will grow capital. So with that, I want to thank everyone for joining us today. I want to thank Envisant for having me here. Wonderful, wonderful group. They do wonderful things for credit unions and everyone. So thank you very much, Bindia. I appreciate the time.
No, thank you, Charlie.